I'm going to know if I'm going bald or not. That's going to be interesting. Credit score updates. The updates to how banks will set your interest rates based on your credit score are going to be great for the average home buyer, but they may be disastrous in the long term if investors and home buyers are not collectively careful. What do I mean? Well, to understand what I'm saying, we need to look at a couple of things. For example, what the new quote-unquote rules are and what they mean to the average home buyer, and yes, to the above-average home buyer. We then need to do a compare and contrast with the rule that led up to the Great Recession of 2008 and 2009 and why they were a catalyst to disastrous macroeconomic outcomes. Once you understand all of that, then the table is set for you to know what to do to protect yourself, and heck, to even profit. If enough people have this info, then calamity can't be avoided. So be sure to share this video with friends and like so that the word can get out. But let's dive right in by looking at the new rules and what they mean. What will these new rules mean for the average home buyer? There's three things that we're going to be looking at. What the new rules are, what they mean for the average investor, and what will the new rules mean for the above average home buyer. Also, what behavior will this encourage? Let's take a look real quick at habits of home buyers that already exist. Now, home buyers already buy more house on average than they need, which is opposite of renters. Renters outside of the renting hotspots, New York City, San Fran, Miami, Austin, etc. They typically only rent what they need and no more. If you have a large family, then you rent a 3-bedroom, 2-bathroom, single-family house. Single with no family, then a studio or a 1-bedroom will do. A home buyer typically will get enticed into buying a larger property, typically in a more expensive neighborhood, because it's a good investment. This new set of rules will probably encourage us even more. So during 2008 to 2009, actually the run-up between 2006 to 2008 to 2009 is typically blamed on banks and insurance companies. And let's not forget Wall Street, and with good reason. They had a lot to do with it. Namely, taking and trading of financial instruments, which derived from mortgages, which are a type of bond, chopping them up and then selling them on bond markets and other over-the-counter markets where these sorts of things are bought and sold all the time. You may remember people talking about derivatives and may have heard the term mortgage-backed security. But what is that exactly, and how did it contribute to the Great Recession? Well, you heard the term derivative because a mortgage-backed security is a type of derivative. That is to say, it's an instrument that is derived from some other instrument or equity, in this case, a mortgage, which is actually a type of bond. When you go to the bank and you ask them for a mortgage on the house that you want to purchase, the bank, in a way, is issuing a bond at a specified interest rate. And this interest rate they hold. Now, the bond that they are issuing, they hold it, and you agree to pay on that bond. Technically, maybe not legally, but technically, the bank can either hold on to that bond themselves and accept the payments for it, or they can sell it to someone else, still accepting the payments from you, the bondee, but in that instance, they pay the person they sold the bond to, the bondee that is. Now, the bank can also break that bond into multiple pieces and combine that bond that they issued with other bonds that they also issued, mix them together, and then sell them to other investors. This takes us back to 1995. Now, from 1995 to 2005, doing that was extremely profitable for many financial institutions and investors. Presumably, these instruments were relatively quote-unquote safe because they were essentially mortgages, which at the time were perceived to be more safe than bonds in general. Why? Because mortgage requirements were typically very stringent. You know the drill. 20% down, you'd have a means to pay the mortgage, i.e. a JOB, and you just had to be creditworthy in general. That wasn't always the case. We could go into the history of it, but there were some acts in Congress that were passed. These laws and regulations that were passed enabled quite a few borrowers to not actually be creditworthy at all. Let's not forget about the introduction of the ARM, or adjustable rate mortgage. Now, that's a mortgage instrument that adjusted its interest rates according to a number of factors, including the Fed funds rate, which all of a sudden went up in 2006, thanks to some inflationary pressures that were occurring at the time. Sound familiar? That only added fuel to the fire of home buyers not being able to afford the homes that they were living in. Not being able to make payments on homes that they lived in made the credit default swaps that were based off of those very mortgages that the banks and the financial institutions issued, then diced up and amalgamated together, and then sold together. All of those things became essentially worthless. Not all of them, quite a few. So people who invested a ton in these instruments were left holding the bag. People who understood that that game of musical chairs was about to stop, thanks to interest rates going up. Folks like Michael Burry, those guys made out like bandits. Others who sold first survived the carnage. A few institutions went completely belly up. Others needed to be bailed out. You know the story. Now, this rule change that's coming up is likely to have a similar effect. It will encourage people to purchase homes that they normally would not qualify for. And because of that, it could have ramifications that we will not feel for 5 to 10, maybe even 15 years from now. That is, unless we use the knowledge of the past to inform our economic and financial decisions today, which is why we should get smart. What do I mean by getting smart? There are really 3 ways that you need to get smart about the rule changes that are happening. A, learn to buy less house than you need. Don't be tempted to buy more house than you need. Be wary of the good investment semi-fallacy. Owning a home is only slightly better than renting for your entire life, particularly if you get a long-term mortgage greater than 15 years. In a lot of cases, you end up doubling the cost of the house if you do not make an effort to pay off your mortgage early. Speaking of which, if you're purchasing a house specifically to live in, you should be making every effort you can to pay off your mortgage early. Ideally, you purchase the house that you need and no more, but given that, you should be finding ways to put a little extra into every mortgage payment, even if it's only $1 or more. Every little bit that you pay off now is going to save you thousands, maybe tens of thousands of dollars in interest payments. You should then be investing those savings into something that is paying you interest, like bonds, which leads me to the third thing. Be very, and I'm talking about very careful with any investment instrument you purchase, including and especially maybe bonds and instruments that are derivatives of bonds. Are you investing in a company that has a ton of bonds? Make sure you do your research to figure out if they're holding a ton of mortgage-based bonds, derivatives of mortgage-based bonds, etc. You need to know, have they vetted those mortgage holders? Are they individuals who are purchasing homes that they otherwise would not have been able to afford, thanks to the new rules? What percentage of their portfolio is invested in these instruments? Inquiring minds need to know. Investing in the stock market, particularly broad-based index funds and ETFs, well, it might actually be safer. Thanks to these new rules, the inflation that seems particularly rampant in our economy will eventually push prices of stocks and instruments like stocks up. And just like in 2008 and 2009, while a nosedive in stocks will likely occur during any recession caused by the after effects of these rules, the market will naturally self-correct, and simply owning a piece of it will enable you to weather the storm. Will these rules make it harder for people who improve their credit and work harder to have a good credit score? Will it make it hard for them to get mortgages? Actually, probably yes and no. Will it make it easier for people who were not as careful, who did not plan as hard, who are not as fastidious to their finance as others, to purchase homes that they can't afford or shouldn't be able to afford? More than likely, yes, it will. But with the right knowledge in hand and plan in place, you, me, and everybody can in fact come out of this with minimal bad side effects. Speaking of bad side effects, if you want to know why owning a house is not quite what it's cracked up to be, take a look at this video. And don't forget to like this video if you liked this video, and subscribe and turn on post notifications. Keep in mind, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Take it easy, guys. I'll catch you in the next one. Peace.